If my forecast is right on where rates go, by the way, I see the long bond is going to deliver you a total return this year of 20%. I frankly don't think that there is a legitimate scenario that will get the equity market there this year. Well, I think in one word or less, recession is going to be the operative word for 2023. I think that we move beyond the debate of this being a soft landing to recession. I think now the question is going to be how deep and how long. And it was interesting to me to see last week the big banks coming out and saying that they're expecting a mild recession. Even if it's mild, I don't think that there's a lot of asset classes out there that are still priced for a mild recession. I think that especially after this big risk-on rally so far this year, for some reason, everybody's got, soft landing back on the brain. The overall theme is this. It's basically 2022 was the year of the aggressive interest rate actions from the central banks led by the Fed. 2023 will be the year where the lags from those interest rate hikes percolate through the economy, earnings, and cash flows. It's going to be a rough year. If the Fed sees what I see and they start cutting rates and re-steepen the yield curve in the second half of the year, 2024 is going to be a different story. But this year is going to be an equally rough year as last year for risk-on investors, especially in the equity market, but for different reasons. It won't be so much the multiple contraction this time. It'll be the outright earnings recession.
And the length and depth of a recession, are you on the same page as the banks you mentioned?
Well, they didn't really give a timeline. I think everybody is hoping for transitory. So I think that it's difficult to pinpoint how many quarters this recession is going to be. A lot is going to depend on the Fed's reaction function. The longer the Fed drags its heels, the longer it remains consumed by inflation fear, and the longer that the yield curve stays inverted, the deeper and longer this recession is going to be. My sense is that, if a plain vanilla recession is usually 2 to 3 quarters, and usually GDP might go down, roughly 2%. I'm not so concerned about the peak to trough decline in GDP. So much of GDP is insulated from recessions, healthcare, education, utilities, shelter. You need to have a real humdinger of a decline in cyclical spending to cause a gut-wrenching decline in GDP like we had back in 08 and 09. That's a one-in-a-century event. My big concern is that this is going to probably last longer than people think. I'm more concerned about the duration of the recession than the magnitude, and that once we get out of it, I think the recovery is going to be very subdued. For the people that believe in the higher for longer interest rate thesis means that the Fed is not going to ease policy as much as they should. You don't get much of a recovery out of that. So I'm taking a big picture view here for the next several years. People ask the question as you did, so we get a recession, what does it look like? I'm also thinking not just a recession, what does it look like, but what does the inevitable recovery look like? And I think it's going to be a series of small case W's. And I say that because there's just not a lot of pent-up demand right now. There might be pent-up demand in China. That's a different story. But in the U.S., we just basically, lumped in a whole cycle of goods-related spending in a short period of time because of the pandemic, the lockdowns, but all the stimulus checks. It just created one giant distortion in the economy. And there's going to be a long-term payback for that. And I know that people say, well, we're still service-driven, and that much is true, although a lot of the reopening trade that's benefited travel and tourism and restaurants and hotels and the like and theme parks, that's already played out. There's not a lot of extra impetus from that. But we front-loaded so much consumption of stuff because of the pandemic and because of the fiscal policy that we had. Long-term payback from that. So it's not just the recession. It's what's the longer-range outlook for U.S. economic growth. I'd have to say it's very tepid.
And that front ending of the spending that you were just referencing, is that why you seem rather firm on the notion that that inflation will melt away in 2023?
I'm absolutely convinced that inflation is going to fall. It's going to fall faster than people think. I know that we talk about inflation. It's a process. It's like it's a race between watching grass grow and paint dry. But I think that the conditions are in place for inflation to decline materially. Now, a lot of people talk about, well, we have deglobalization and the return of labor power, although I don't really see that. But let's wait and see what the longer range outlook for inflation is. I think that there's a lot of assumptions that go into that. Let's just take a look at what we know staring us in the face. We know that when you're going to forecast inflation, and I'm going to talk a bit like an economics professor right now, but the first thing they teach you in economics school is about supply and demand. Because if you don't have a supply and demand curve, you can't forecast the price of anything. So we're talking about, say, consumer prices, the consumer price index. And the one thing that really strikes me is this, is that in the 3 years since COVID entered our lives, real GDP growth has averaged less than 2% at an annual rate. That includes the pandemic, the early stages of the pandemic, the lockdowns, all the stimulus, the reopening, and then last year's very weak economic performance. Over the past 3 years, real GDP growth, and GDP is aggregate demand. GDP is all about spending. It's averaged less than 2% at an annual rate. And what was real GDP growth in the 3 years leading up to COVID was 2% at an annual rate. And this is a message for all the people that say we're back into the 1970s. Why? Why is that the case? In the 1970s, the first of the boomers were in their 20s, loading up on homes and autos, refrigerators, appliances, electronics. The first of the boomers are in their 70s today. It's a totally different demographic. In the 1970s, when people talk about the inflation in the 1970s, it wasn't just about union power and about sclerotic government policy. When we weren't in recession, when we were not in recession, and for 3/4 of the time in the horrible 1970s, the economy was actually expanding. Okay, and aggregate demand growth was running at over a 5% annual rate. When was last time that happened? And that's because we had very vibrant demographics. We could argue about government policy, and we could argue about coming off the gold standard, and we could talk about trade unions and wage spirals, but we had actually tremendous real demand growth in the 1970s. When was the last time we had 5%? So I'm trying to say here that we had 2% growth in demand in the 3 years leading up to COVID. And in the 3 years after, we've actually averaged less than 2%. And all I hear is inflation on everybody's brain because people just can't seem to see past the tip of their nose. And it's just human nature to extrapolate your most recent experience into the future, which is a very dangerous mistake to make. So here's what happened. We have weaker demand growth, even with all that stimulus, all the stimulus checks, and the reopening trade and the vaccines. We've actually averaged weaker demand growth, and yet inflation today in the United States sits just over 6%. We peaked at over 9%. Before COVID, it was 2%. So let's get this story straight. We actually have inflation at 6% with weaker demand growth than we did pre-COVID when inflation was 2%. So what does that tell you? It tells you something about the supply curve, that we got hit with these recurring inflationary shocks from the supply side, not the demand side. And that was because of the COVID. It was because of China's approach to COVID, which elongated this process of dysfunctional global supply chains. And then, of course, we had something unexpected exactly a year ago, which is this Russian invasion of Ukraine. And we know that wars are inflationary. And so that's really what the story has been, these series of recurring supply shocks in the context of demand that actually was more subdued today than it was when inflation was last at 2%. So I don't know about you. I'm just looking at the data. You see, this is not an opinion-based inflation forecast. I'm not making some assumptions about deglobalization or assumptions about the labor force participation rate and people not going back to work. I'm just looking at the facts. And the facts are that when you look on the supply side, and you look at the vendor delivery delays, whether it's in the manufacturing indices or the service sector PMI, or you're taking a look at other measures of transportation bottlenecks, they have eased dramatically. In fact, the Baltic Dry Index, which is the poster child for global shipping rates, is not only lower today than it was pre-COVID, it's back to where it was in 1990. I don't see anybody talking about that. The only person I see talking about that is me, but that means I have to go and read my research that I write every day. But what is it that people don't understand? You need a supply and demand framework. Now, what's interesting is that Jay Powell, when he started to raise interest rates in March of last year, at the press conference came right out and said, we are going to be operating policy with a blind eye towards the supply side. Because it was a case of once burnt, twice shy, and we're just too embarrassed, and our credibility is at stake. And so even though the Fed was a transitory, the abandoned transitory, even though we all know that 18 months in the overall annals of economic history is transitory, and after being burnt by all the recurring supply shocks, they said, we're not focusing on that. So what's happened is they're focused. This is the most epic tightening cycle since 1981. And of course, Paul Volcker in 81 was focused on the supply side. Well, how do you cure inflation? Is you destroy demand. The situation in the United States and really globally is that the supply chains are actually, the problems there are easing. Transportation costs are also subsiding. And we have commodity prices not collapsing, but off the boil. And all the while, they focused on how are we going to get demand. So what's happening right now is the central banks are trying to crush demand, but not with the same supply curve we had 12 or 24 months ago. The supply curve is becoming actually less inelastic. So when I plot these curves out, which you have to do, inflation's only got one way to go, and it's down. And the latest data are actually showing that the CPI ex rent is starting to deflate. Call it 70% of the CPI is deflating outside of rents. And we know how the rents are calculated by the Bureau of Labor Statistics with these distributive lags. But we're seeing in real time, 4 months in a row, month over month, rents are coming down. This is going to show up in the second half of next year, at a time when all the lags from the commodity price decline and the dollar strength is going to continue to deflate goods prices. And all I hear is, but service sector pricing is sticky. It's sticky. It's sticky. Well, I don't know. There's only two parts of the service sector I'm seeing right now where there's still some pricing power. Accommodation and restaurants. And you're seeing whether it's delivery services, whether it's telecom services, whether it's IT services, education services, medical services, they are starting to decelerate very sharply. And the last man standing is rents, but that's a lagging indicator. So I'm a little concerned that the Fed, instead of it relying on some sort of forward-looking model, is really operating policy on lagging and coincident indicators. And so I think by this time next year, inflation is going to be flat. It could even be negative. And so I think that's going to be the big surprise. It's one of the reasons why I do like long-term bonds, is I think that there's still this resistance, and I love it. I love the resistance to my view, because when that ends, I have to move on to something else. But the surprise, by definition, to the markets will be how far and how fast inflation falls in 2023.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.